Gentlemen, my name's Stephen Fletcher. I'm Head of Retail Distribution at GSFM, and on behalf of all the team at GSFM and Epoch Investment Partners, thank you very much for joining the webinar this morning. I'm very pleased to have with us two speakers today from Epoch. Our first speaker is John Tobin. John is a portfolio manager of the global equity shareholder yield funds that many of you use on behalf of your clients. And many of you would have met John on his regular trips down to Australia. Now today, John will talk to you about the shareholder yield portfolio. He'll talk to you about performance and also current positioning of the fund. As you all know, the number one investment objective of this portfolio is to deliver income, that 4 to 4.5% per annum. And it has been very successful in doing that for a long period of time since we launched the funds back in 2008. However, in light of COVID, I know that some of our clients were a little bit concerned about the dividends and potential dividend cuts from companies around the world and within the portfolio. Pleasingly, the fund was able to successfully navigate its way through COVID, and John will talk about the impact of dividends and more broadly about capital allocation policies of companies within the fund today. From a growth perspective, the market environment has been less favourable for yield-based strategies like shareholder yield, and these strategies have lagged the broader market. So why is this so? What are the reasons for this, and what can investors expect moving forward from yield-based strategies like shareholder yield? So John will also talk to this point as well. Now, our second speaker today is Kevin Hefner. Kevin is a global investment strategist at Epoch. Kevin is a regular author and co-author of the insights and white papers that Epoch produce and that are so widely enjoyed by our investors. We're pleased to have Kevin today, and he's going to talk more from a top-down macro perspective. There's a lot going on in the world today. So we've actually posed Kevin a couple of questions. The first question is around, what can we expect from the Biden administration? From a markets perspective, who is likely to be the winners here and who potentially could be the losers? The second question we put to Kevin is around the vaccine. And we've seen 2 vaccines come through now. So Kevin will take us through the timing of these rollouts. And I think with this vaccine optimism, we've asked Kevin to assess the implications for bond yields and also equity sector rotations and the value cyclical rotations that we've started to see unfold in equity markets in recent weeks. So I'll ask John to go first, and then he will hand over to Kevin. And then when Kevin's finished, I'll come back and we'll do the Q&A session towards the end. So please, if you've got questions along the way, add them to your Q&A box at the bottom of your screen, and we'll look to answer as many of those questions as we can in the time permitted. So with that, ladies and gentlemen, I'd like to hand you over to John, and welcome, John. Thank you.
Thank you, Steve, and good morning, everyone. So as Steve said, there are 2 things that I'm going to talk about this morning. First, a little bit on the income and dividend characteristics of the strategy, and give you some sense of why we feel very strongly that this is an income strategy that will be resilient and robust in the face of the challenges that the world economy faces right now. And then a few slides to talk about the relative performance of the strategy and put that into a context that might help you understand how to interpret the relative performance of the strategy in the recent past. So if we turn to slide 2 in the deck, one of the things that I'd start with is back in April, we hosted a webinar called "The Death of Dividends Greatly Exaggerated." And while we were reading at the time that the pandemic would lead to a massive wave of dividend cancellations, we thought that view was too dire. And indeed, what we laid out in that webinar back in April is the view that our historical analysis indicates that during recessions, earnings pressures and dividend pressures tend to be concentrated in a relatively small number of sectors: financial companies, consumer discretionary companies, and to a lesser extent, industrials and materials. And at the same time, there are sectors where dividends hold up quite well. Tech companies, healthcare companies, consumer staples, utilities. So there is this historical record that gave us some reason to be confident that it would not be a widespread, broad reassessment of shareholder distribution practices. In that webinar, we pointed out that The Economist magazine had laid out sort of a triage process, and we thought this is a helpful way of thinking about it back in March and April. There will be companies that are severely affected and that have to require government assistance to survive. Airlines, for example, surely we would expect them to have to adjust their dividend practices. There may be businesses that are cyclical companies, and in the face of a steep and sudden recession, that their business will contract in such a way that they too will be forced to adjust their dividend payout policies. But there will also be companies with solid balance sheets and resilient business models, and they will be able to continue to pay their dividends and maybe even continue to grow their dividends. The chart that you see here on the bottom of the page shows as well that dividends, the share of dividends is also concentrated in a few sectors. Energy and banks in particular represent a large share of the overall amount of dividends that are distributed. And so what does that mean? It means that declines in a couple of sectors can make the overall data look worse than they really are. So we concluded on the next slide in this webinar, there's a lot on this slide. I'm just going to highlight a couple of things, but this was one of the conclusions. This was the conclusion slide from our webinar back in April. Did desperate times call for desperate measures? Well, they do. And during the COVID-19 recession, many businesses we expected would have to cut their dividends and would reduce their share repurchases. But many companies, as I said, we expected would have solid balance sheets, resilient business models. They would be able to continue to pay their dividends. Some companies we thought would even be able to increase their dividends. So our conclusion was that the report on the death of dividends had been greatly exaggerated. It's a challenging period for sure, but like previous recessions we had seen before, it would not lead companies to change sound capital allocation practices. What you'll see on the next slide is an update. So in early October, we revisited this topic in our regular quarterly capital markets update. And what we highlighted here is indeed what we had seen over the first 7 or 8 months of the pandemic was what we had seen previously. So a familiar pattern. Some dividend decline was evident, but the dividends in aggregate were falling less than earnings, as we expected. A little table at the bottom shows the average for the 9 past recessions, the peak to trough change in earnings, about 20%, in dividends, about 10%. So we expected to see dividends falling less than earnings, and that is what we have seen so far. In addition, as you can see on the next slide, we were anticipating that the pressures would be concentrated in a few sectors, and that is what we have seen. And you can see there in that dividend per share percent column, the second column of numbers, the dividend percent changes in consumer discretionary, communication services, financials, industrials. That's where the pressure was focused. And in other sectors, dividends increased in many cases. We also expected to see and did see that share buybacks would be the shock absorbers. This is what companies would adjust as they try to maintain their dividend payouts through a period when they're experiencing headwinds. So on the next slide, I've included this quote here. We've said over and over again, going back to March and April, that we did not think that the pandemic would lead companies to abandon sound capital allocation policies. These capital allocation practices and policies are well-founded, well-established practices, and even though the pandemic represents a challenge, we did not think that companies would abandon these policies. This is a quote. This is the president and chief executive officer of MetLife. And this is a quote from their Q3 earnings call about 2 weeks ago. Asked on the call about their capital allocation policies in the face of the pandemic. And here's what the president and CEO said. What I would say around capital management philosophy is it has not changed. We believe excess capital above and beyond what's required to fund organic growth belongs to our shareholders and should be used for share repurchases, common dividends, or strategic acquisitions that clear a minimum risk-adjusted hurdle rate. I'd point out that MetLife increased their dividend in April, and they have recently restarted their share repurchase program. So this is just one anecdotal piece of information, but it underscores what we mean when we say companies won't abandon these capital allocation practices and policies. So now on the next slide, what I'd like to do next is turn to this question or this topic of relative performance of global equity shareholder yield. And let's be honest, it hasn't been flattering in recent periods. And so hopefully with a couple of slides here, we'll put it into some context and make it something that's more understandable and explainable, if you will. So over the past 3 or 4 years, the performance of the shareholder yield strategy, I would argue, and we feel at Epoch quite strongly, the performance has been in line with expectations, which is to say, we've maintained an average cash dividend yield in that 4 to 4.5% target range. We've maintained volatility below market volatility. And we've maintained a diversified portfolio that has insulated the strategy from any individual stock missteps. We'd point out that the strategy delivered strong upside participation in 2017 and 2019. Those were years, you'll recall, when the market moved ahead quite aggressively. And this is a strategy that is never going to keep up or exceed the market when the market is behaving like that, but we will deliver good upside participation. And in both of those years, we delivered about 75 to 80% of the market upside. And then in the fourth quarter of 2018, if you remember, a very significant market drawdown, and the strategy provided very good downside protection in Q4 2018. So what has changed? Well, the first half of 2020 has indeed brought some challenges with the unprecedented COVID-19 pandemic. We saw companies that pay dividend called into question. And as I said just a minute ago in talking about our death of dividends, greatly exaggerated webinar, there was a lot of pressure on companies to simply stop paying dividends. That was a pressure on our strategy, and not just our strategy, any dividend or income-oriented strategy. We also saw, especially at Q1, that traditional risk-on sectors took on some defensive characteristics during the market correction, and some of the traditionally reliably defensive sectors were not as defensive as they had been in the past. Energy stocks suffered disproportionately during this drawdown in Q1, and it was a combination of a supply shock and a demand shock occurring simultaneously. And of course, energy prices fell dramatically. But as I said a minute ago, nevertheless, through this period of time, the dividend yield has remained above 4%. The data point that you see there on the slide is as of June 30th. As of September 30th, it was still over 4%. And as of today, it's still 4%. So we're able to maintain that 4 to 4.5% dividend yield. What's even perhaps more noteworthy is that the vast majority of the portfolio holdings were able to maintain their dividends. And indeed, we have seen through the end of September, 54 companies raise their dividends this year. In October, we had 6 more portfolio companies raise their dividends. So we are seeing companies that are able to maintain their dividend distribution practices and policies. The next slide shows 2 charts, and we've been focusing on this in our shop quite a bit, trying to understand what's been driving the market and what is it that's been and creating a headwind for the shareholder yield strategy in terms of its relative performance. There isn't anything that I'm going to say that's new and shocking. You all know this, but perhaps these two charts show it really dramatically. On the left is the 5-year history, and on the right is the 3-year history. We're looking at the MSCI World Index. So this is just the market. But what we're identifying here is the factors at work, the factors that are driving the market higher, momentum and growth, and the factors that are significantly out of favor. And the factors that are significantly out of favor over the 3- and 5-year period are high dividend strategies and value strategies. So as I said, we all know that, but this really makes it graphically evident that these are the headwinds, the relative performance headwinds that a strategy like global equity shareholder yield has been facing. And if you flip to the next slide, you can see another analysis that furthers this point. The market has been led by a narrow set of stocks. It is a lot of the Megacap tech and e-commerce stocks, the FANG stocks. We all know who they are. We all know how these stocks have performed. So what we have done with this chart, we're looking at the MSCI World Index over the past 5 years, and we're looking at the index as it's reported. That's the yellow line, and the darker line is an equal weighted index. So the index is, of course, a cap weighted index, but the cap weighted index is heavily influenced by the larger stocks. So Apple, for example, which has a $2 trillion market capitalization today, and Microsoft with a $1.6 trillion market capitalization, and Amazon and Google. These are all very, very, very large companies, and they're driving the index. And when you put the index on an equal weight basis, you can see how much those individual stocks have been driving. The smaller chart at the bottom of the page shows a cumulative impact over the past 5 years. Maybe we should have drawn a nice dark line at 0, but what I would draw your attention to is sometime around the end of 2018, you can see the upward slope in that line and the cumulative benefit emerge for these high-tech and e-commerce stocks. You can see that the widening gap between the equal weighted and the cap weighted index. Again, another way of showing you that this has been a market-wide phenomenon that's created a relative performance headwind for the strategy. The next slide might not be that familiar to you. This is a peer skyline, but what we've done with this is, what we're trying to point out is that while the market has created relative performance for the shareholder yield strategy, the investment process and the structure of the strategy consistently exhibits attributes that should be attractive for long-term investors. So the way to look at this chart, each one of those bars is a factor, and the yellow square shows the shareholder yield relative to peers. So for example, the earnings yield bar shows that the shareholder yield strategy, in terms of the earnings yield factor, is top quartile. In terms of the cash flow yield factor, is top quartile. In terms of the dividend yield, it's actually a significant outlier above the top quartile. In terms of return on equity, it is just at the top of the second quartile, almost first quartile. Net profit margin, clearly in the top quartile, and market beta, very, very low. So these are the characteristics of the strategy, and they may be obscured, perhaps, in the kind of market environment where we see the same stocks leading the market higher, and we see the relative performance of shareholder yield consistently lagging behind. So maybe if we turn to the next slide as a review, what is the mission? What is it that global equity shareholder yield sets out to deliver? Well, what we're focused on in managing this portfolio is identifying companies that generate free cash flow in a consistent and reliable fashion, and that have a proven and demonstrated ability to allocate that free cash flow effectively between returning it to shareholders and reinvesting for growth. And for better or worse, many of these mega cap tech and e-commerce stocks don't fit this description. They're outside of our investable universe. We seek to diversify the sources of shareholder yield as much as possible so that we can increase the likelihood of achieving our desired objectives. The portfolio tends to be more of an equal weighted portfolio. We're trying to, and we strive to deliver the shareholder yield components of the cash dividends, the share buybacks, and the debt reduction with lower volatility than market benchmarks over time. And finally, to deliver an abundance of income, diversified to assure investors both of an attractive level of income and a growth rate for that income stream. Looking ahead on the next slide, to put this perhaps into perspective, one of the ways that we think about this, so on the next slide, if we can flip that one. I'll keep talking. There we go. The way we think about this, the perspective that we have at Epoch Investment Partners is all investors have a balance that they seek to achieve among capital preservation, growth of capital, and income. And there's always a need for investment income. Investors should seek an income strategy, we believe, that is specifically designed to deliver this outcome, sustainable and growing yields through a portfolio construction process. And the shareholder yield strategy represents a comprehensive income strategy. We're focused on shareholder yield. We're focused on all the ways that a company can return value to the owners of the business: dividends, share buybacks, and debt reduction. Now, we don't know when the market will be willing to move away from this growth at any price mindset, but eventually it will. And we believe that the shareholder yield relative performance behavior will improve when that happens. The next chart is a busy one, and I'll try to tell you what the highlights are and main takeaways here. What we're trying to illustrate with this chart is that over its history, and it's a 15-year history for the shareholder yield strategy, we've invested in a diversified portfolio that has consistently held companies that pay dividends and use excess free cash flow for share buybacks and for paying down debt. And you can see the returns year by year of both the strategy and the MSCI World Index, and it moves around from year to year, so it's certainly true that the market is moving around, and this consistent focus on delivering the components of shareholder yield is sometimes obscured and not so obvious. So that's the main takeaway for this slide, that year in and year out, this is what we focused on delivering: companies that have growing cash flow, companies that pay attractive and growing dividends, companies that use excess cash flow to buy back stock and pay down debt. And that's what we've been able to successfully achieve over time. On the next slide, this is a slide that we've used forever, and it shows the number of companies in the portfolio that have raised their dividends. Now, the number of companies in the portfolio is ballpark about 100 stocks. It varies a little bit from year to year. At the moment, I believe we have 107 stocks in the portfolio. But so one way to think of this is that year after year after year, this is a portfolio where somewhere between 2/3 and 3/4, or maybe even a little bit more, of the companies in the portfolio are raising their dividends. Year to date, and that's through September 30, the number was 54. 54 companies raised their dividends so far this year. And as I mentioned earlier, we've had 6 companies raise their dividends in October, so we're up to 60. And I saw a company with a positive dividend announcement today. So we're continuing to see companies raise their dividends. And I think what we're trying to say with this slide is that by the time we're finished with 2020, the number of companies in the portfolio that will have raised their dividend is not that different from what we've seen in most prior years. So I've got a couple of slides to just conclude before I hand it over to Kevin. This just shows the strategy's dividend yield over time, going all the way back to the beginning in December of 2006. And that dark line on the top is the dividend yield for the shareholder yield strategy. It has consistently been between 4 and 4.5%, and it has always been above 4%. And below it, you can see the Barclays Global Aggregate Bond Index. And for income-oriented investors, fixed income is a challenging place to look for yield. Our view is the best place for investors who seek income. The best place to find that is in a diversified portfolio of high-quality companies with growing cash flows that pay attractive, growing dividends. On the next slide, one of the enduring characteristics of the strategy over its history has been downside protection. And as I alluded to earlier, we did not deliver the downside protection that we've historically seen in the first quarter of 2020, but we believe nevertheless that the track record is intact. The numbers that you see here include Q1 2020, and it tells us that over the history of the strategy, when the market was negative, the portfolio outperforms, not all the time, 72% of the time, and by an average of about 3.3 percentage points. And when the market is down significantly by more than 5%, the strategy also outperforms consistently. Not all the time, not every single time, but 83% of the time. And it outperforms in those down markets by an average of about 4.5 percentage points. So I'll end there. I think if you have questions, I'll be happy to entertain them when we get to that. So I hope to hear some good questions from you, but right now I will turn the microphone over to my colleague, Kevin Hefner.
Okay, thanks, John. This is Kevin. So I'm going to talk about a couple of the issues that Stephen was mentioning earlier. The subtitle of this section is the beginning of the end, and that is the beginning of the end of the global pandemic. And I think the vaccine announcements are very important for the market outlook and sector rotation going forward. I'll start off though talking a bit about the Biden administration and what we should be expecting over the next couple of quarters. It's still early days. We did have some announcements today about the White House staff of Biden, but we're seeing in general where he's appointing people who he's known for decades, moderate people, experienced, they're pragmatists, they're not ideologues, they're not people who are new to DC, not new to governing. So I think that's all good news. In terms of key spots, we keep focusing personnel as policy. And this is a statement that's been used about DC at least since Reagan's time. But for the Treasury Secretary, there is a short list that's getting a lot of attention. Lyle Brainerd, Janet Yellen are at the top of that list. And again, they're people who have a lot of experience, great CVs, very experienced, great pragmatists, and would do a terrific job. We've seen some shortlists for USTR in charge of trade. That's very important. The SEC, and there's some rumors that we might get someone who's fairly active in there. The DOJ is especially important. I'll talk about tech later on, commerce, health, and particularly with Biden, labor is going to be a focus of a number of his policies. So that will be important. It did seem that one of Trump's main objectives was reversing Obama's policies. And I think to a large extent, that's going to be the same thing for Biden, is we're going to see a flurry of executive orders in the first month or two, and a lot of those reversing EOs that were put in place by President Trump. In terms of Biden's platform, there's, in terms of broad strokes, I've taken these issues from his website, and I put an X through things which he's likely not going to be able to do, but were priorities for him in his campaign pages. And without a majority in the Senate, and he's unlike, maybe there's a 1/3 probability he'll get to majority in the Senate, depending how the elections in Georgia go in early January. But in all likelihood, the first 4 items, I don't think he'll be able to make much progress on. The next ones, though, he can do largely with either moderate senators or through EOs. Certainly pharmaceuticals, there's people on both sides of the aisle who want things done there, and I think that's pretty important. Regulation, most of this can be done through executive orders. He's very much focused on energy, the environment. You may see some of the nonsense that's going on with drilling rights in Alaska and wildlife areas this week. He'll overturn that immediately. Labor is also very important to him. Consumer finance has traditionally been important to Democrats. Biden hasn't said a huge amount, but that's a risk area for some areas in finance. Certainly trade, which was a focus of Trump. And he had very much ideological people, Lighthizer, Navarro on these positions. He'll be reducing tariffs, which would be a headwind for EPS in a number of sectors, using investment tax credits to promote onshoring. Trump's talked a lot about that, but in fact has done relatively little. Will continue to be tough on China, but much more multilateral, working with Europe, Japan, Australia, Canada, and so on. In terms of positive impact, certainly clean energy, electric vehicles, some exporters, cannabis is a very, very small part of the market. And in terms of infrastructure, Biden was hoping for a very large package, but there are a lot of moderate GOP senators who do realize that we need some investment in infrastructure. So something smaller is still possible. Negatively impacted sectors, conventional auto, fossil fuels, defense, some of the tariff beneficiaries, still aluminum. Those tariffs are likely to go very quickly, so there could be some pain in those sectors. And then depending upon what happens on the consumer finance sector, some areas of finance could face some headwinds. Now, on the next slide, we're still talking about Biden in a bit more detail on his regulatory agenda, and that will be especially important if the Democrats do not get a majority in the Senate, which seems likely. Clearly, the focus initially will be on the pandemic. Very frustrating now that he's not able to work with the transition team on that. But the logistics of getting over 600 shots of the vaccine to people in America, production, distribution, prioritizing who goes first, and ultimately incentivizing people to get the vaccine. They need to be doing that immediately. Maybe it won't start happening until January 20th, but earlier. There'll certainly be incentives for onshoring, personal production equipment, active pharmaceutical agreements, and so forth. That's important. And overall, it's sort of strange that we have to say it, but public policy is going to be determined by a broad team of experts. And it's weird that we have to say that. On pharma, a lot can be done through executive orders, but also there will be people crossing the aisle to help Biden on some of these policies. Environment and energy, extremely important to Biden and has been for a long time. He won't ban fracking, but in terms of new leases on federal land, including the land in Alaska, certainly that will not be going ahead. Zero emission vehicles, so electric vehicles, there will be a lot of incentives in that area. And one of the things to do immediately, and there will be some senior appointments in the Biden administration with a lot of experience in this area, will be rejoining the Paris Agreement. Banks and consumer finance, we have to see, but traditionally this has been a focus of Democratic administrations. In big tech, I'll talk on the next slide, we talk about it in some detail. In fact, today at the Senate Judiciary hearings, we had the head of Twitter and Facebook, Jack Dorsey and Mark Zuckerberg, speaking. And there's a lot of areas where both, this is the Senate Judiciary meeting, but both Senate and House, GOP and Democratic senators want to see a lot done. On antitrust, there really hasn't been a major antitrust case in the US since Microsoft in the late 90s. The DOJ has recently alleged that Google broke antitrust laws. It's quite a narrow suit that they've brought forth, and it looks like they'd have a reasonable chance of winning this suit. It alleges that Google's entered into exclusionary deals for its search service for both Android and Apple phones. And there's certainly the rumor mill is that we'll have a second case filed against Facebook soon. But ultimately, the focus is to ensure that we can have competition existing, have innovation, so it remains just a click away. And a focus on 3 areas. One is acquisitions that stifle competition. For example, Facebook acquiring Instagram and a number of other companies. That's the focus. If you're interested in these sorts of areas, there's a wonderful book came out a couple months ago called No Filter by Sarah Fryer on the Facebook acquisition of Instagram. And it's a great read. And now it's on most of the best business books for 2020. Both running a platform and participating in it, there currently is anti-competitive suit in Europe against Amazon for this, but it's something that could also affect Google and Apple, and then exclusionary deals similar to the ones that the suit with Google alleges. In general, these cases take years. They have taken decades in some cases, but one thing that's interesting is if you look empirically at the cases before Microsoft, IBM, AT&T, Standard Oil, shareholders have benefited from them. We've ended up, in fact, say with Rockefeller, going back to the very first big case, this is when Rockefeller became quite rich. Microsoft shares outperformed both the tech index and the S&P while their suit was going on in the various stages. So there's certainly this could cause a lot of choppiness in the tech sector, but typically it's not negative for shareholders, and there's various reasons for that. Data privacy is a second area. This is much more important in Europe, I think, for obvious reasons than it is in the US. The big focus in the US recently has been Section 230. Section 230, this is of a 1995 Communications Act, gives tech companies blanket immunity for content that's posted on their sites. The GOP is very much against this because they think Twitter and Facebook and other companies use this to censor conservative views, and Democrats on the left worry because we get a lot of hate speech and it's very divisive. And this is receiving an incredible amount of attention in the US. And if you're surprised, Biden has called for just revoking Section 230. That seems unlikely, but I think they could work across the aisle and come up with a real reworking of Section 230. What this means is that the big media companies will have to come up with a way. Mark Zuckerberg thinks AI is going to do this. That's a bit laughable, but it certainly is going to change the nature of these platforms. And I think there's a high probability this happens over the next 2 years. And then China policies, clearly we're going to see major changes in policies towards China with the Biden administration. I think this is an area which typically Australians are much more aware and cognizant of than Americans are. Still, it's going to be anti-China. There's a lot of concerns about China with tech, with national security, but there's an awful lot of areas in which the two countries can work together that Trump has not been very successful with. Now, turning to the next slide, from Biden to the vaccines and this issue that we are now at the beginning of the end of the global pandemic, the immediate question we all want to ask is, well, when can I get a shot? And probably 9 months to 12 months for a lot of us. There will be a prioritization. Frontline workers, healthcare workers, the elderly, then younger people, students, and people with comorbidities, but then eventually people who are working in jobs like ours. I would guess late summer, well, our summer, early autumn next year. And the infectious disease experts think that by the end of next year, 61% of Americans will be vaccinated. There is a lot of worries about adverse side effects from the vaccines and that the approval process could be rushed for political reasons. I think given what we've learned through about BioNTech and Pfizer, and more recently with Moderna, and then going further with J&J AstraZeneca, is fantastic science, path-breaking work with messenger RNA. And I think these concerns are going to be going down. The effectiveness of the vaccines, I show on the top left chart, very high relative to other vaccines. The seasonal flu shot typically has a 44% effectiveness, and we're looking with the COVID-19 messenger RNA vaccines, something in the low 90s. 51% of Americans say they would take a COVID vaccine given what they know today. This is down dramatically from May of this year. So it's come down because the process seems so political. But I think as people learn more and the nature of public health policy in the US improves, I think these numbers will come up. And even if it looks like we're having a hard time convincing people to take the vaccine, I think there can be financial incentives, for example, offering people, once we get through the first groups, if it looks like we're having a hard time getting above 50%, though even 50% with 90% effectiveness will ensure herd immunity. If we want the number above that, I think financial incentives, for example, giving people $1,000 to take a shot or whatever the number ends up being to work, I think that will make sense. And we'll have no problem ensuring that a sizable majority of Americans do receive the vaccination. So the news we've had over the last 2 weeks with BioNTech and with Moderna, wonderful science, great for the recovery, and certainly means that we're now entering the beginning of the end of this process. Looking at the next slide, if this does happen, what sectors should we expect to improve? And this is work that's been done by Goldman Sachs. Their measure of vaccine optimism is taken by what's called the Good Judgment Project. If you've read anything about super forecasters, Philip Tetlock's group, so they do work on trying to quantitatively assess the probability of a vaccine being available, and then how that measure, that quantitative measure, correlates with sector performance. So the sectors that should do well, clearly hospitality and leisure, the ones that have been mobility impacted, commodities, cyclicals as the cycle improves, airlines, again, mobility impacted, consumer discretionary, value stocks, finance, and so on, should be outperformers. And the ones that should have faced some type of headwinds in this environment would be defensives, healthcare, some of the growth sectors, some of those related to the digital economy. And I think that makes sense. Turning to the next slide then, if we do have optimism about the vaccine, this means that we're going to be having a better growth profile. It seems reasonable to expect interest rates to move up moderately and the yield curve to normalize. That certainly happened in the last 2 recessions as well. The yield curve flattens pretty dramatically, and that's because the short end comes down faster. Then the long end comes down, short end comes down, we get a very flat yield curve. And then over time, the short end stays where it is and the long end moves up, so we get a steepening. And that is what we've been seeing. And certainly, it would seem that during the cycle, it'd be reasonable to expect the yield curve to steepen by another 70 basis points, something like that. I think it's going to be difficult for the yield curve to steepen as much as it has in previous cycles, given the enormous amount of debt we have at the corporate and government level, less so with households. But we certainly should be seeing the long end of the curve move up and the yield curve steepening. This is important because, as we show in the bottom chart, value relative to performance compared to the S&P is 62% correlated with the 10-year yield. For some sectors like banks, it's 75% correlated, and then tech typically underperforms when the 10-year is going up. So low interest rates are very good for growth sectors like IT, in particular long duration sectors like much of the tech sector. And we have a table on the right, and this looks at over the last 20 years what has been most highly correlated with either movements in bond yields or PMIs. And you can see that as bond yields go up, banks, insurance, value, energy, industrials, materials, different cyclicals typically do very well. And we get a similar ranking if we see an improvement as the cycle matures with the PMIs. And I think that's pretty straightforward. The next slide, sorry. Looking more at tech. So there's some tailwinds in this environment for value type sectors. Are there headwinds for tech sectors? As John was mentioning, there has been excessive concentration in a small number of names over the last couple of years. And you can see here focused on the FAA and M names. This is an acronym from an Australian, actually, Gerald Minnick, but Facebook, Amazon, Apple, Alphabet, Netflix, and Microsoft. Enormous outperformance, certainly over the last decade or so, but particularly as the chart in the bottom right shows over the last 5 years. Concentration in the sector. And actually, if you look at the S&P excluding these 6 names, the value sector really hasn't underperformed relative to the S&P, taking those names out. So I don't know if it's irrational exuberance in those particular names, but enormous performance. And recently we've seen some of this performance being taken back, but in an environment in which growth is improving, the yield curve is steepening, that the digital economy names, the tech names, will be facing some relative headwinds. Moving to the next slide, please. This sector just looks at valuations. The top left looks at the growth index within the S&P versus the value index, and just looks at the difference in PEs of those two groups. The top left chart looks at forward PEs. We have data for that for 20 years. And you look right now, it's way above the historical mean, and that suggests that one should be a bit worried. The chart on the bottom right looks at the trailing PE. We have a longer time series going back 25 years for that, and that includes the tech bubble. So certainly there's reason to believe that the tech valuations are stretched, but certainly it's nothing like the late 90s bubble. So there is a valuation headwind, I would think, for tech and growth stocks, the digital economy, relative to value. Some people compare it to the late 90s, and I don't think that's really a fair comparison at all. So there is a headwind, but I don't think it's bubblish the way we were 20 years ago. And then moving to my final slide, given that we are seeing this change in the last 2 weeks with the announcement of these path-breaking vaccinations, we are at the beginning of the end of the global pandemic. It does seem reasonable to expect some sector rotation going on. Typically, these sector rotations happen because money moves around. And the chart on the top left just looks at assets in money market funds in the US. And currently, it's just over $4 trillion. Normally, money in these funds goes up during recessions. And then when the outlook starts to improve, money goes down as people rotate out of money market funds into equities or other asset classes. And I think there's every reason to believe that over the next couple months and quarters, we will see money move from the sidelines, from money market funds into equities and other asset classes further out the risk curve. And I think this will be one of the catalysts for the type of sector rotation that we've been discussing. In terms of value versus growth, people like to use this. I think it's quite a crude distinction, in particular given the unique nature of the recession we've experienced this year. For example, since February, the consumption of services is down 6% in the US relative to February, while goods consumption is up actually 7%. So to some extent, we want to be focused on those sectors that have been impacted by immobility, certainly transportation, tourism, hospitality. And this is where we should see a strong rebound in free cash flow next year. Also, we'll see some cyclical sectors doing better, just as growth returns and as the economy, it's certainly not a V-shaped recovery. We've been referring to it as a swoosh-shaped recovery, but as the economy comes back. And then as John was emphasizing, overall, Epoch believes that the companies that are best positioned to do on the startup environment are those that have demonstrated ability to produce free cash flow on a sustainable basis, and then allocate that cash effectively between capital return options and reinvestment in acquisition opportunities. I'll end there, and thank you for the time. I look forward to your questions.
Okay, well, thanks very much, Kevin, and also to you, John. Thank you very much. I'm just trying to get my camera working here. There we go. So why don't we move to a few questions now? And John, this is sort of more pointed at you. In terms of share buybacks, have you noticed many companies foregoing share buybacks throughout 2020 that will likely resume heading back into 2021 and beyond?
Steve, I think the short answer is yes. As I mentioned in some of the comments that I made with the slides that I went through, the historical record is that the share buyback it's a shock absorber, and during market downturns, during economic recessions, this is where companies conserve on cash. They face an earnings decline, they try to maintain their dividends, and the flywheel, it's sometimes referred to, is the share repurchase program. So we have seen companies reduce their share buybacks, and we have also started to hear from some companies that they have resumed already their share repurchases. One area that's particularly interesting, perhaps, is the financial services sector, where there have been a variety of regulatory regimes around the world who've imposed restrictions on dividends and or share buybacks, in some cases rather heavy-handedly. In the European geographic region, the ECB has prohibited banks from paying dividends or buying back stock. There's a lot of discussion in the press recently about the bank regulator in that region beginning to allow companies to resume paying dividends and to resume buying back stock. I bring that one up because it's an interesting one in the sense that many of these companies entered the pandemic with very strong regulatory capital positions, with the ability and the willingness to continue to pay their dividends. And yet the regulatory pressures either cause them to cancel their dividends, put their dividends on hold, or in some economic regions, reduce their dividends. We've seen that with the Australian banks, for example, or hold their dividends flat. And we've seen that in the US and in Canada. In doing so, the companies have, in fact, generated even more capital organically. So what I'm getting at is that for many of these institutions that are in a strong regulatory capital position, that have seen their regulatory capital position actually expand during this period because they've been prohibited from share buybacks, they've been prohibited from increasing their dividends, as soon as they get the green light from the regulators, they're very likely to begin paying dividends again if they've been restricted, to start growing dividends again if that's been restricted, and to resume share repurchase activity if that's been restricted. So it's all about sound capital allocation practices. And if a company has excess cash that it can't deploy to earn a return above its cost of capital, it should find some way to return that to the owners of the business.
Okay, great, thank you. There's a good question coming through here. How do you see climate change and related government policies affecting your investable universe and companies that are in the current portfolio? So
good question. I would say it's one of those slow moving phenomena. The recognition of climate change, the recognition of the need to do something about it. Kevin talked a lot about how the Biden administration will likely focus on some of these environmental issues, provide incentives for electric vehicles, provide incentives that reduce greenhouse gas emissions, rejoin the Paris Climate Accord agreement. So I think it is a phenomenon that will play itself out and will have an impact on businesses. As we look at our portfolio today and the exposures that we have, there isn't anything in the portfolio today that I think we would look at and say, we really need to get rid of that if some policy about climate change is going to come with the Biden administration. But it is certainly something that we will be mindful of and monitoring. We will be looking for opportunities. One of the things that I'll mention in that regard, we do, as everyone knows, we have a fairly significant exposure to the utility sector. And indeed, many of the utilities that we own, what's attractive about them is their ability to invest and grow their rate base, and as a result, generate earnings growth to support attractive growing dividends. The investments that they're making and that are getting entered into their rate base are frequently investments around renewable energy sources. So they're building transmission lines to connect to wind farms and solar energy fields. So this is actually a positive development for many of the utility companies that we invest in today.
Okay, great. Just another question, and we might make this actually the final question. I'm just conscious of running up towards that 1 hour. It's just around the COVID vaccine, and Kevin, you spoke to the different sectors and what sectors you thought would do well based on the vaccine, and what sectors wouldn't do as well. So really, John, this is probably more a question for you. And have you made any significant changes at a portfolio level to benefit from sectors and companies that are best placed for a recovery as a result of the vaccine in terms of cash flow and dividend growth?
So no, not really. And it's a strategy that is not so much a thematic strategy. We're not trying to catch a wave and be in the right place at the right time and ride that wave. But one way to answer the question without trying to brush it off, in a way, and much of what Kevin was talking about, this potential rotation that we might see with momentum and growth type names, and the shift from growth at any cost to more value-oriented types of strategies, more income-oriented strategies. I guess what I'm saying is, in a way, we're already positioned for that kind of rotation. We're already positioned with a value tilt. And so as the economy starts to open up, as the COVID vaccine starts to get rolled out, I think this, without us having to change our portfolio to benefit from that, I think the headwind that we've been facing that I spoke about will start to ease and maybe even turn into a tailwind for us.
Okay, terrific. Well, look, I think, as I said, we're running up to the hour, so I might call an end to the questions now. We do have a few other questions there, which we will come back to you with and answer those questions for you. But I just wanted to, first of all, thank you, John, and thank you, Kevin, for your presentations this morning. I'd also just like to, once again, just as a way of wrapping up the call, to say on behalf of GSFM and also Epoch, thanks very much for joining the call, and thanks for your long-term support of the strategy. It's very much appreciated. It has been a challenging time for shareholder yield from a relative return perspective, but hopefully after hearing from John and Kevin today, you have some information that you can use with your clients that explains why this has been the case. It's interesting, we launched these funds back in 2008, and when you go back, I had a look yesterday at the deposit rates back then across the big four banks. You could get a term deposit that was paying nearly 8% per annum back in 2008 in Australia. Today, CBA are offering the same term deposit for just 60 basis points per annum. So as John pointed out during his presentation, generating income from defensive assets today is problematic for investors. And for that reason, we think a global equity strategy that has a 12+ year track record in delivering sustainable and growing income can play a really important role in a retiree's portfolio today. And arguably, this strategy is even more important or even more relevant than when it was when we first launched it back in 2008. But once again, ladies and gentlemen, thank you again for joining the call. We'll get the presentation out to you shortly. We'll also follow up with your CPD points. But once again, on behalf of everyone, thank you very much. And we look forward to seeing you all again very soon. Thank you.
Okay.